We had some very shocking information about inflation come out this morning, a couple hours before the Federal Reserve met to talk about the benchmark interest rate. We have all of that news for you and more right here on Keeping Your Business on Track. Hi, I'm Joe Harris, and I'm here with
Nick Morgan.
Nick. How's it going, Nick?
I'm doing well, Joe. How are you?
God, what an exciting morning. Like, I felt like it was the Super Bowl day, and I'm waiting for 2 o'clock to hear what the Federal Reserve was going to say after just a shocking bit of news about inflation.
Yeah, it was shocking, and it was a shock to me. I really wasn't keeping up. I've been on a little bit of a vacation, so I woke up this morning, checked the market, and I was in for a pleasant surprise.
Yeah,
you know?
And that's crazy. I mean, the inflation data is such a driver for the other markets. Like for the stock market was rallying, Bitcoin was rallying, bond market was rallying this morning. Pretty much all asset classes. Everyone loves cheap money.
Yes. Yeah.
Everyone loves cheap money.
Yeah, and it came in better than everybody was expecting. So, as we have talked about prior, you know, when that happens, when it comes in better or worse than expected,
it's a shock.
Big things happen.
Big things happen. So, you know, I was talking to someone yesterday, and they're like, well, I don't understand. Why does inflation impact things like stock market, right? And I explained very easily, like if you're getting a 5% return on your cash in an FDIC insured account, it's like, why? You don't have much motivation to move that money out of cash and into a higher risk asset class. Like if you're getting 1% or 0%, like many people still get in their own bank, which is absurd to me. But if you get a low rate of return, you're going to go seek a higher rate of return somewhere else. And 5%'s high enough with low risk that you're like, well, I'm not moving my money out of there. I'm okay with 5% for this money. But if it goes down to 3, 2, 1, you're going to go seek a higher rate of return for your money.
Right.
You're going to go into stocks or equities. You're going to go into bonds, maybe crypto or Bitcoin. And by the way, we are not financial advisors. This is not financial advice. Do your own research before investing in any of these things. But it's just fascinating how big of an effect the higher interest versus lower interest has on the markets. Yeah,
definitely. I mean, like you said, just the base saving account, I mean, probably the lowest risk thing you could ever have is at an astronomical rate right now.
If you're at 5%, it's like, why do I need to go seek out 10% with actual risk?
Right, exactly.
You know? Yeah. It's crazy.
Yeah. So with that being said, do you want to talk about the numbers on inflation? You know, what did they actually come in at, and why are people surprised?
Yeah, the first piece of this whole puzzle is the inflation and the inflation data that came out this morning. So let me give you accurate. So the month-over-month core CPI. CPI is Consumer Price Index. And they look at a basket of goods and what these things cost. And did the price go up or did it go down on these things? And they were expecting it to come in about 0.3% month over month. So the prices have risen 0.3%, right? If you extrapolate that over a month, in other words, if it was 0.3% every single month for a year, that'd be 3.6%. Right?
Sure.
Did I do that math right?
I think so.
Okay, good. Woo. And so it was forecasted to come in at 0.3. It was 0.3 last month. It was forecasted to come in at 0.3, and it came in at 0.2. Now you're like, okay, it's only 0.1 off. That's no big deal.
Right.
But 0.1 times 12 is 1.2%. So the actual, if you, like I said, if you annualize that 0.2, it's 2.4% versus 3.6% inflation. And if you remember from previous podcasts that we've done, the target rate is 2%. So we're moving in a positive direction towards the target. And the Fed is like steering a huge freighter, right? They've spun the wheel and it's turning. Well, they don't want to overshoot their mark, right? Because it's hard to get that thing to move. It's so big, it moves such a big economy. So big deal. The annual core CPI, that's looking on an annual basis. Again, we were expecting 3.6%. I'm sorry, last month it was 3.6%.
Right.
We were expecting 3.5%, and it came in at 3.4%.
Beautiful.
So a lot of people might listen to this and say, well, that's only just a tiny difference, 0.1%. But we're talking about trillions of dollars at stake here.
Yeah.
That 0.1% represents many, many billions of dollars.
Right. Yeah.
So big deal.
Yeah.
Big deal.
Awesome. Yeah. So it's great to hear. And like you said, people weren't expecting it. They were expecting the
higher number. Yeah.
Just staying baseline at 3.6%. It's come down lower. So it looks like we're kind of trending in the right direction towards that 2% mark. Do you think, or are they expecting this trend to continue? And what caused this decrease in the first place? Or was it kind of an anomaly? Or
Well, it's not, there's no anomalies. It's based on the data that they get. And there's a whole list. If you go out and search out the, the Fed, if you look at the CPI data, like if I just go and Google CPI and I go to the Bureau of Labor and Statistics and I look at the consumer price index, it'll show you that basket of good and which ones are up and which ones are down. But here's the important thing to remember is that the lower inflation gets, the better the chances are that the Fed's going to reduce their rates. Because the big news today that you haven't asked me yet, that I'm sure you're waiting for, we'll get to.
Yeah, we'll get to.
Okay, cool.
Yeah. But do you think that trend of 3.6, 3.4, will it go down to 3.2 year over year? Do you think that's going to continue? Are they predicting it to continue, or have they said anything about it?
Well, they have. I mean, it's moving in the right direction.
Yeah.
And as we track this thing, 'cause remember, it was like 8-9% a couple of years ago.
Yeah.
Or a year and a half ago. And it's been trending in the right direction. They're trying to pull it down to keep that inflation from running out of control.
Yeah.
Inflation is not your friend. You know, it's like if, people have told me in the past, if you keep your money in the bank long enough, it'll be worth nothing because of inflation. You'd have to keep it there in a long time. But what they're saying is that cash in the bank is inflation ruins cash in the bank.
Right. Yeah.
And ruins savings, and everything costs more. And then the job, it does a lot of things that, we don't want. We want growth as an economy. We want that 2%, according to the Fed. Where'd that come from? I'm sure there's lots of scientific data that they came up with to get there. But we want to get back to that 2%, according to the Fed.
Okay. Gotcha. Now, like you said, the big information is, how is this going to affect their interest rates? What was the announcement today? So we are recording the day of the Fed announcement.
Yeah, we're recording this on June 12th.
June 12th, correct.
We'll probably release it this afternoon or tomorrow morning, I imagine. So you might be getting this on the 13th of June, so still relatively fresh. The interest rates, okay, so after the CPI data, when it looks less like inflation, people are more likely to go invest in things like bonds that are fixed income instruments. They have fixed rate of return. They're more likely to go and buy those things and get ahead of the curve, because if they buy them when they're a little bit less expensive, as inflation drops, they'll become more valuable, right? So they're paying less for them now. So they kind of want to get ahead of the curve. Well, we saw the bond market rally this morning, mortgage-backed securities, which really dictate the mortgage cost on the street. Those markets did very well this morning. Rates might drop just a teeny tiny bit today. But again, it's forward movement in the right direction.
Yeah. Awesome. So that's really good to hear. And then is there any, you kind of touched on it, but indication for rates moving forward? Like we discussed, it's kind of been up and down. Well, there is going to be a rate decrease this year. Maybe not. Maybe it'll be held out to the end of the year, right? It's always a moving target in what people are predicting. But does it now look like, again, that we might get a rate decrease this year?
Well, I think it's evident we didn't get a rate increase today.
Yeah.
And there was only there's a CME, it's called Market Watch. It looks at the Fed and the Fed's likelihood. It takes a survey of a bunch of different economists. The likelihood that the Fed will reduce the rates. The likelihood of a rate reduction today was only 4.9%. So no one really thought, very few people really thought the Fed was going to reduce their rates today, their benchmark rate. And that's the rate at which banks borrow money overnight, typically the overnight rate or the benchmark federal funds rate. And, that rate directly impacts things like car loans, student loans, credit cards, prime rate. I already said car, but it already affects those things directly. In other words, if they had reduced the rate by 0.25%, well, you might see your home equity line of credit interest rate that's tied to prime typically go down by 0.25%.
Yeah.
But it doesn't directly impact mortgage rates, right? It's an indirect fact because the people that are buying mortgage-backed securities that help come to a price or an interest rate, they're looking at the same data because it has the same effect on a mortgage-backed security. So, which is what dictates the rate on the street that we give out here.
Right. Yeah, absolutely.
So, that the likelihood of a rate change today was good because the CPI data is coming down, and the likelihood of a federal funds rate decrease in the future, they started to push that out a little bit.
Yeah.
They're only predicting run rate decrease this year. Of about 25 basis points. Next year, they're predicting 100 basis point decrease, which 100 basis points is 1%. It might go from 5.25% to 4.25%. 4%, 4.25%, 4% next year, whereas that reduction keeps getting pushed out.
Yeah. Okay. Sweet. And speaking on other factors that may affect the mortgage rates, last episode we discussed on the Fed meeting, we talked about quantitative tightening,
right?
Which, if you want to check out that episode, we went into detail on basically what that means.
Why don't we put that at the end?
Yeah, we'll put a link in there.
Okay.
And is there any update on that?
Yes.
On what they're doing with that?
Actually, a pretty big update. Last time around, they made mention. This was the big news last time around, that they made mention that they're going to reduce their balance sheet. Right. The balance sheet is the amount of assets that they have that they own.
Yeah.
And they're going to start selling those off.
Yeah.
Right. And they were doing that. They were reducing their balance sheet to the tune of $60 billion, $60 billion a month or $60 billion a month, I think.
Okay.
And they're going to reduce that to $25 billion a month. They're only going to sell off $25 billion worth of their assets. I mean, that's a lot of money.
Yeah.
But they have trillions of dollars in assets.
Yeah.
And when you sell something, that puts a lot more sell pressure in there, which starts to reduce the price, which drives the interest rate up, the yield up.
Yeah.
And so by reducing that reduction, reducing the amount that you're selling, you don't put as much sell pressure into the market, which means that the prices aren't driven up more.
Yeah.
So it actually helps rates start to normalize and that market start to stabilize over time.
Yeah. And so they started that June 1st?
June 1.
June 1.
Yep.
So that just took effect.
That just started out.
And is there like a delay? There'll probably be a delayed effect on it.
Of course.
Yeah. Right.
Yeah.
So it'll take some time, but that's also another step in the right direction.
It is.
So.
It's a step in helping the rates start to normalize.
Cool. Awesome. I think that's all the questions I got for you.
Okay. Well, a couple things. I mean, a lot of people look at this market. A lot of smart money is looking at this market as an opportunity. Because if you think about it, if everyone thinks the rates are going to go down in the future, what are they going to do?
Invest?
Or they're going to wait.
Yeah. Well, yeah.
Yeah, they're going to invest, true. But if you think the rates are going to go down next year, you might wait to buy a house, right? And that if you're waiting, it stands to reason there's a lot of other people waiting. And there's a lot of smart money right now is saying, look, these home prices really haven't changed a whole lot. There's been a lot of talk, prices are going to go down, prices are going to go down. In our market specifically, we haven't really seen a lot of pricing going down. We've seen a reduction in the list price, but that's because a lot of those homes were overpriced to begin with. But the average price of a sold home hasn't really significantly decreased.
Yeah.
And what the people that are waiting for, a lot of other people are waiting for. And when it actually happens and the rates go down and there's a frenzy to get back into the market, all this pent up demand, pricing is only going to go one way.
Right.
You're going to end up paying a lot more for that house. The nice thing about buying now is that people get to lock in the price of the house. Yeah, they might have a higher interest rate, but if the rates do go down, they can always not always, as long as they can still qualify and the values and all that things are there, which they're predicted to be. It's possible that they might be able to refinance and get the lower rates. They're going to be winning the advantage of buying the house at less price and getting a lower interest rate over time. If that happens. I think that's all we got here today. I mean, let's look at the news from today. The Consumer Pricing Index, or the CPI, it came out better than expected. It came out lower than expected. That caused the markets to respond in kind, and rates dropped just a little bit today. The equities markets are up today. Bond markets doing better today. Bitcoin went up today 3 or 4%, which I love. And this is good news for interest rates. The Federal Reserve met today, and they said that we're not reducing the benchmark rate today. We've probably seen one cut this year. We see 100 basis points of cuts next year, which means rates are going to go down over time. But if you wait, you're going to be like everybody else, and there's going to be a feeding frenzy for these. This is my opinion. I could be wrong. There's going to be a feeding frenzy for those homes again, and prices are going to rise again. So smart money, it seems to be, is buying houses now, right? A lot of investment firms are buying houses now, and they have a lot of data, right? So that's all I got. Hope you got some value out of this. Like, share, subscribe, and we'll see you next time.